The stock market is at an extremely critical point as we await the June 14th FOMC meeting, where we'll find out if Jerome Powell wants to raise interest rates, if he wants to pause, or if he wants to do something called a hop, which we will explain for you in this episode, because there has been some data that came out this past Friday that has just changed a lot. A lot of expectations have changed. So we're at a critical point, man. And also we got some news on the debt ceiling that we may have come to a resolution finally after having a standstill for months. So we're going to update you on all of that, and we're going to tell you what we did with our portfolio. So you definitely want to stay tuned for that, because you might take notes. So Newski, let's get right into it.
Yeah, I got you, bro. All right, so let's start with explain to you guys what happens when you pause or increase interest rates, right? And give you a little history lesson. So essentially, over the stock market, the interest rate cycle is not anything new. So this basically means that history might be repeating itself. So when you pause an interest rate, right, basically saying that we're not going to increase for the time being. Doesn't mean we're decreasing, it just means we're not increasing for the time being. The stock market shows that it has gone up 6% on average for the next 3 months after the pause. But this did not happen 3 times. So in 69, in 73, and 81, it did not happen. It actually fell by 6.5%. And that's because the economy wasn't the strongest. So hence, the economy is not necessarily the strongest because inflation is still high, right? But what about the pivot? So, Rel, obviously we know that when you pause, that's different than pivot. You want to explain what pivot actually means in the stock market and what the interest rate pivot actually means?
Yeah, pivot is just when they're actually going to start decreasing rates. Because like he said, we may pause, stay right there. Once we decrease, that's a pivot.
Yep, exactly. So when we actually pivot, this has meant that in 7 out of 9 times, the market has fallen. 7 out of 9 times. So you might think it's good news, but it's really not, because it fell 23% on average. 23%, bro, that's absolutely insane. So when that happens, it's like, yo, what's actually going on, right? Like, is this actually making sense? But then the 2 times it didn't happen was in 89 and 95. And that was when inflation was actually 2 to 3%. And we're not at 2 to 3% right now at all. So it's like, yo, what's actually going on? But now that you understand what history has shown, right? You guys understood that, yes, it did go down a large percentage. There's one thing that a lot of people don't talk about, and we wanted to actually share an article on this. So let me pull that up really quick, right? Basically, guys, it says, this is by Motley Fool. You will see the description, and you will see the link in the description below. If you scroll all the way down, right, there's one thing. This right here is something very important to look at. So it says, history also shows that S&P 500 is headed towards a new bull market. So you might be like, wait, what? This is making sense? But let's go into it, right? The federal funds rate has peaked 11 times since 1970, meaning there have been 11 rate hike cycles during that period. The S&P 500 produced an average return of nearly 15% during the year immediately after those cycles, okay? With gains in 8 of the 11 years. So just think about that for a sec, which means, well, when did we last increase rates, right? Or when did we, like, just come to agreement that we might be pausing?
In May so far.
Exactly. And there was news that we were going to stop in June, but that's obviously changing right now. But if you think about it, if May and June is when we might be pausing, we might be like doing something here, yo, that means that we really might be headed towards the bull market. And next year, May, we might see an actual return of 15%, which would be huge.
Yeah, that'll be major, bro.
Right?
15%. We've already been rallying. The NASDAQ is up 20-something% this year.
Exactly.
We have been rallying. So an extra 15% on top of that over the upcoming year. I know that's the S&P, but still, if the S&P is rising 15%, so the NASDAQ is going to continue to rise as well.
Exactly. But that is very important, because if you think about it, we have to pay very close attention to what's going to happen with the interest rate, right? So let's go to this actual Fed watch tool, right? We go over it all the time. But Rel, you want to walk them through this really quick, and I'll click on whatever you want in terms of months.
Yeah, so if you guys see right now, this is showing you what's expected to happen at the June meeting. This is the official tool that gives you expectations on what Jerome Powell and the Federal Reserve will do with interest rates at their meetings. And if you scroll down a little bit, you'll see that there have been changes over the past day, week, and month. So basically, it says right there where you see where it says current, That's currently where our interest rates are right now. They're between 500 to 525 basis points, which means 5 to 5.25%. Okay. Now, if you see just 1 week ago, it says almost 83% were expecting that in June's meeting, we were going to pause right there, meaning we're going to stay with the interest rates at that level. Now, if you see currently, only about 36% are saying that we're going to stay paused at this level. The number has increased now. And if you see right below that, they're anticipating that we're going to have to increase interest rates again by 0.25%. 64% of traders are believing that. That's a huge change. That's a complete turnaround that just happened this past Friday. It was not like until a week ago, but this past Friday, things have completely shifted. And that's due to the PCE data that had just come out. And so you see right there, it shows that PCE inflation is higher than expected in April. Now, Jerome Powell has been clear that everybody talks about CPI, but he tends to look at PCE more. They consider it to be more of an important measure. And so if you see right now, it says that the PCE index rose 0.4% in April after increasing just 0.1% in March. The core PCE, which I said is the preferred inflation data that they use, has also risen 0.4% month over month. So it remains high at 4.7%, which is up from 4.6% in March. So the Fed is not happy with this news. And that is exactly why you see that back on the Fed Watch tool. That's why you see, since this came out on Friday, you see that we're going to have to potentially increase interest rates again in June. And I don't know how the stock market is going to like it, but I will say on Friday, we were rallying. We were going up. So I don't know if the stock market is just shrugging this data off or what. But what I know is that they might have to increase interest rates again.
Yeah, and I think the biggest reason for that is really because Jerome Powell actually said in his last meeting that he's going off of data. Like, he's not opposed to pausing rates, but he's not actually saying that I'm just going to do whatever I want. He's looking at the data and basing everything off that. So that's why this news is very important. And I'm going to be very honest with you guys. I think the reason why the stock market went up on Friday and just rallied is because you guys wanted to rally. There's no reason where it's like, oh, like if we see news like this come out and we're seeing what Jerome Powell is saying, I think it's just going up because people want it to go up, bro. At the end of the day, like, people have money, they have money ready to buy, and they're ready to put money into the market. And that's going to increase the market.
And I think also it's just that they're seeing that companies are performing in this time period. Like, you've seen Nvidia's earnings, for example. You've seen all these other earnings in other sectors too. Just earnings in general was just not nearly as bad as they projected it to be heading into earnings season. And I think some stock market is saying, you know what, the best CEOs in the world seem to be handling this environment, and they're pretty much get used to inflation remaining at elevated levels. We're handling the high interest rates. We're getting the best of both worlds. Let's go up. Pretty much.
Yeah. See, yes, but I just disagree with that part, just simply because, I mean, we're going to get into this at the end of the video, so make sure y'all stay tuned. But at the end of the day, like, when a company becomes overvalued, that's what you have to look at, right? And certain companies are becoming overvalued, which we're going to get into. So I'm going to make sure I hold off on that part.
Yeah, no, that's a different story. I was just saying why we're continuing to rally.
Yeah, no, I understand that. And I think at the end of the day, like, I really do think there's a lot of retail buyers just ready to run it up. Like, they really want to see the bull market, and a lot of people do. I can't blame them, but that's a different story in itself. So let's actually talk about, right? Let's switch up the topic now. Let's talk about the debt ceiling, give them an update on that piece, because there has been news and it's been very interesting as well. So it says Biden and McCarthy have a debt ceiling deal. So yes, they have a deal, but you guys want to make sure you actually read the whole article. Because there's a lot that went on, right? So we know the debt ceiling, it's basically like the credit card limit on the country. That's the best way to look at it. Like, once you hit that credit card limit, it becomes a very big deal. So it's the same thing. Once the US has hit a certain amount that, we can't borrow anymore, right? If we borrow, it's gonna be a problem. We can't go above this limit. It's between the Republicans, I'm not trying to get political, it's between the Republicans and the Democrats to be like, are we going to increase this limit? Yes or no? And if we're not, it could be a very, very big problem. So we covered this in detail in our other episodes. But now, as of this morning, there was a actual potential deal or a tentative agreement, right? So it says President Biden and House Speaker Kevin McCarthy have a tentative agreement that will raise the debt ceiling and end the standoff. However, if you start, you stop reading right there, you get super happy. This is the part that I get like, yo, what? It's only 2 years. It says the deal will only limit, the increase for 2 years. I don't know if I like that, bro.
Yeah, I agree. I mean, I think, but that's kind of what we've been dealing with. We just raised it a little bit, like you say, like you usually say, we just kicking the can down the road.
Literally.
That's just what we're going to continue to do. Like, we're going to be right back here. But what it does is makes everybody get quiet until the next presidential election, post that, and that's what they want.
Right. Yeah, and that's the thing, right? Because everyone's going to be out here on their own trying to make things work. But I know there's a couple points you want to hint at over here for how they're spending and everything of that sort. So let me know when to stop.
Yeah. So I mean, even around right there, you could see that if you see like the Democrats, they have a focus on making sure that they keep the government programs and make sure that Americans are getting the assistance they need, while the Republicans are the ones who are saying, hey, I want you guys to cut spending because you're spending way too much. We're not really concerned with those programs like that. And as you see, what they've come to an agreement on is, what? Cool. We could keep those programs, but we got to start being a little more
conservative,
critical.
I guess.
Yeah, conservative on who we're letting into government programs. So that's exactly what they're doing. And that's what you see here. And even things like student loans, the Republicans like, you know what, we're going to chill with you guys. We're going to chill out on that. We're going to chill out on get that out of the spending right now, because you know what, the Supreme Court is going to handle that anyways. So the Republicans kind of chilled out. They were also able to come to an agreement. And they also have agreed upon the fact that, the non-defense spending, we're going to keep that at current levels, and then we're going to start increasing that by 1% starting in 2025. So they were able to come to a tentative agreement right now. It looks like things are handled. We'll see how things transpire over the upcoming couple of years. But for now, it seems that they're good. And I think the stock market may like that news. It's left to be seen. But have been pretty much consolidating the stock market for a while, waiting on this resolution. And it seems we've got one right here.
Yeah, and this is the part, right? Because at the end of the day, guys, like the two parties have completely different stances. Like Democrats are open to actually like increasing and getting the limits going in there and putting money in, versus the Republicans, they're not. So with the election coming up, that's why the 2 years is so crucial, because based on the election, this is gonna be very, very big. Like in fast forward 2 years, because it's gonna be like, yo, who made this decision? Who was in the party, right? Who was in the House, and what led to that conversation, right? Like, was it the GOP or was it Democrats? And based on that conversation is going to potentially determine the next winner as well. So there's a lot that goes into it. It's just not the current news. You have to look at the future aspect of it as well. But that's basically what's going on right now when it comes to the Fed watch tool, what the interest rates are looking like, and then the update with the debt ceiling. We might see other updates because the deal, once again, is tentative. It's not like fully disclosed all the information, but this is the news that we have as of right now. But I know, Rel, let's talk about the Nvidia really quick, bro. Let's put them on.
All right, so you guys know, like Nvidia, we've seen what they did on earnings. Monumental, literally historical, an amazing earnings beat. And you've seen their stock go up to 30% post earnings. It was ridiculous. And then you've seen right now, Nvidia's PE ratio at this point is now 177, almost 178. That is considered to be extremely, extremely overvalued. They consider companies to have good PE ratios when they're down at like 15 or 20.
That's the average. 15 is the average.
Exactly. So now you see it over here at 178, extremely overvalued. Now Nvidia potentially has priced, could potentially run a lot more than what it has right now, being around, let's say $390 around there. Last time I checked, you have analysts raising their price targets to up to $500 on Nvidia. So there may be still room to run, but Newski and I decided to take our principal out of Nvidia. And you guys may have seen back in November, we told you guys in the 3-part series that went from November to December, we told you guys to get into Nvidia at that time. We definitely were buying at that time. We were up well over 100% on our positions. We took our principal out.
And I think, my bad, go ahead.
I was just saying we're gonna let the gains ride, but we took our principal out because it's good to take profits. So
Yeah, no, literally. And I think the biggest thing, guys, like, because I think a lot of people struggle with like understanding when to take profits or how to take profits, right? Like when we first started investing, I'm gonna be honest with you guys. Like I personally, I don't want to speak for bro. I personally did not understand how to take profits or like what to exactly do in that game. But learning and going through the cycle and taking L's has taught me like, yo, profit taking is a great thing, right? You're never gonna be mad that you took a profit, but especially when you're up way over 100%, it's like, yeah, I'm obviously double my money, right? But this is where it came down to the PE ratio. And I know a lot of people make fun of Warren Buffett, a lot of people make fun of a lot of different things, but at the end of the day, when a company's overvalued, that's when you know you're a good investor or not. If you could take your money out and then invest into another undervalued company, right? Or in another asset or in a different venue that might, or venture that might make you more money. That's what it comes down to. So when we realized it was overvalued, we were like, yo, what can we do? And there might be other sectors that might be undervalued right now. There might be companies that might be undervalued. And we will be looking into this and sharing it with you guys so you can make an informed decision yourself as well.
yeah, because Nvidia right now is almost has $1 trillion market cap almost. Like they're about to enter territory there. I think it's like 950 billion right now or something ridiculous.
Yeah, it's about to be the first semiconductor to do that, I believe.
There you go. There you go. And so it's like, yo, guys, to get another 100% increase on our money,
that's when
we're asking a lot out of Nvidia, especially before a pullback. And usually what happens when new innovation comes out is that semiconductor companies see the gains first because they're the ones that are, everyone looks to say, okay, what's the new buzzword? AI. Who's going to be the one taking all the profits from this new gain or this new industry? Semiconductor. The same thing happened when we talked about like mobile, right? The mobile coming out like iPhones and stuff like that. A lot of chips got a lot of benefits on that back then. And then the profits started getting spread out across other industries. That's going to happen here. Semiconductors see the benefits on AI first, and then profits will start to get spread out across other industries over time. So Nvidia is going to have to share some of their profits across other industries as other players start to find ways to benefit. In other words, other competition comes in. So I'm trying to take my money out of Nvidia while it's hot. Not all of it, just we set our principle and then put it into something undervalued, like Newski said, and we'll, like you said, we'll be sharing that. So that's just some food for thought for y'all if anybody wants to kind of take heed on that.
Yeah, and we would love to know what your thoughts are, right? Like, let us know if you think there's an undervalued company out there. Let us know if you're deciding to keep your money in these companies because you think that, yo, like, I think there's a lot more room for growth. Like, we love comments like that because it lets us think ourselves, like, yo, what are other people doing with their money, right? So if you like this type of episode, if you like the updates that we gave, thank you. We appreciate you for still watching, but make sure you like, comment, and subscribe to the channel. Plus, that little notification bell because we drop
2 videos 8 week.
And you don't want to miss them. Make sure you guys are celebrating the weekend as well. Hopefully, y'all had a great long weekend. Memorial Day was here, and you're watching this on Memorial Day. So, honestly, shout out to y'all, and thank you. We will catch you on Wednesday. Until then, peace.
Peace.
Soundstripe.